In 2008, the housing market didn't just look strong. It looked invincible. People believed home prices could only move in one direction. Up. Your neighbor, your co-worker, your barber, your college roommate, everyone had become a real estate genius overnight. Flipping homes was the new lottery ticket. Mortgage brokers were handing out loans to anyone who could fog a mirror. Banks were packaging those loans into exotic financial products that even the people creating them barely understood. It was euphoria disguised as wisdom, a collective hallucination masquerading as prosperity. But while the masses were drunk on rising home values and easy credit, a small group of quants sat quietly behind spreadsheets, running models that nobody wanted to see. The conclusions were blunt, emotionless, and devastating. The whole thing was a time bomb. The defaults weren't just probable. They were inevitable. The math was already written. The clock was already ticking. And when the first cracks appeared, they widened faster than anyone could react. Bear Stearns vanished in a week. Lehman Brothers collapsed under a mountain of toxic mortgage-backed securities. Trillions of dollars in perceived wealth evaporated. The global credit markets froze almost overnight. Companies that had been institutions for decades collapsed in days. Suddenly, we all learned new phrases. Systemic risk, contagion, too big to fail. And we watched something no one had ever seen on that scale. The government printing money by the trillions to stop the bleeding. We were told it was medicine. In reality, it was anesthesia. The patient didn't heal. The pain was simply postponed. Instead of letting the system cleanse itself and reset, policymakers chose to inflate. They lowered interest rates to zero. They expanded the money supply at a historic pace. They injected liquidity into every corner of the financial system to keep it running. And for a while, it looked like we had gotten away with it. The stock market recovered, housing prices recovered, retirement accounts recovered, people breathed again. But underneath that relief was something darker, an addiction forming. We discovered that printing money works until it doesn't. We discovered that cheap credit fuels growth until it explodes. And we learned that once society develops a dependency on stimulus, withdrawing that stimulus becomes nearly impossible without triggering collapse. The result is the world we're living in right now. A world not defined by a single bubble, but by multiple bubbles across every major asset class. Stocks, real estate, crypto, bonds, luxury collectibles, even art and trading cards. Everything has been inflated by the same invisible force, cheap money. It's not just the wealthy who benefit from this environment. It's anyone who holds assets. But the uncomfortable truth is that most people don't hold meaningful assets. Most people hold wages, and wages do not inflate at the same rate as assets, which means the majority have been falling behind while believing everything is fine. The numbers tell a different story. The S&P 500 has surged to record highs. Housing prices are up massively from pre-pandemic levels. Crypto has roared back above trillions in market cap. Gold touched all-time highs. Even collectibles and digital art have sold for astronomical sums. Wealth on paper appears to be expanding. But is wealth actually increasing? Or is the dollar simply losing value? When the money supply expands faster than economic output, each dollar buys less. And when dollars buy less, people who don't own appreciating assets find themselves locked out of the very prosperity that is being celebrated. This is why the average household now struggles to afford groceries, rent, gas, childcare, medical care, and basic repairs. It's why buy now, pay later and credit card debt are quietly hitting record highs. It's why millions are financing their lives like their parents finance houses. On the surface, everything appears strong. Underneath, the foundation is cracking. This is how bubbles form, not from greed alone, but from the belief that the good times are structural, not temporary. The belief that prices will rise forever. The belief that prosperity is guaranteed. The belief that the system is too big to fail. But the economy is not magic. It runs on rules. Money has rules. Debt has rules. Risk has rules. And those rules do not bend because the crowd wants them to. Every bubble in history has shared the same psychological DNA: euphoria, denial, rationalization, and finally collapse. It doesn't matter whether we're talking about tulips in 1637, railroads in 1873, tech stocks in 2000, housing in 2008, or the everything bubble today. Humans chase rising prices. They justify, obviously, unsustainable trends. They convince themselves that this time is different, but it is never different. There are structural realities at play that no amount of optimism or speculation can override. If you inflate the money supply long enough, the currency weakens. If you keep interest rates artificially low long enough, people overborrow. If you make credit too cheap, assets soar far beyond their fundamental value. And if you inflate all assets at the same time, the eventual correction isn't sector-specific. It's systemic. This is where we stand now. The wealth looks real. The prosperity looks impressive. The markets look unstoppable. But under the surface, the leverage, the debt loads, and the liquidity distortions are intensifying. And unlike 2008, this time there is no isolated sector to blame, no single domino to remove, no easy bailout to perform. This isn't a housing bubble, it isn't a banking bubble, it isn't an equity bubble, it isn't a crypto bubble, it is all of them at once. And when everything is inflated together, everything is vulnerable together, which means the next correction, whenever it comes, will not be a sector crash. It will be a system-wide repricing of risk, liquidity, and value. And that is why what comes next matters for everyone, whether they own assets or not. The illusion of stability that we see today has been engineered through one mechanism more than any other: the uninterrupted expansion of the money supply. Since 2020, the amount of dollars circulating in the economy has grown at a pace with no precedent in modern financial history. Nearly 1 out of every $4 in existence was created in the last few years alone. This is not metaphorical, it is literal. The currency supply was expanded because the system required it to survive the shocks it faced. But expanding money is not the same as expanding wealth. It is simply redistributing purchasing power from the saver to the spender, from cash to assets, from wages to capital. The national debt now exceeds $37 trillion. And unlike personal loans or corporate liabilities, this debt does not operate on fixed terms. It compounds. Every year, the government must roll over expiring debt and issue new debt to cover ongoing spending. And the cost of servicing that debt, just paying the interest on it, is now over $1.1 trillion per year. More than the United States spends on national defense, more than it spends on the entire federal education system, more than it spends on nearly any public institution other than Social Security and Medicare. The system is now in a place where the cost of yesterday's decisions is eating tomorrow's capacity. Each additional percentage point increase in interest rates adds roughly $370 billion in new interest costs annually. If rates return to levels we saw even as recently as 2007, annual interest payments would rise past $2 trillion. Almost half of all federal tax receipts gone. Not to infrastructure, not to science, not to innovation, not to defense, not to education, but to simply paying the interest on money already spent. That is the core math that now shapes the system. This is the dynamic financial historians refer to as the debt flywheel. Debt accumulates faster than the income required to service it. Once that flywheel accelerates past a certain threshold, it does not slow down on its own. It grows exponentially, feeding on itself until something breaks, either the ability to borrow or the value of the currency used to repay the debt. Neither outcome is pleasant. Both outcomes require a reset. And every nation in history that has crossed the threshold the United States is crossing now has been forced to confront that reset in one form or another. The consequences are already emerging, but in subtle forms first. Confidence is the foundation of markets, and confidence erodes slowly, then suddenly. When people start to question whether the currency will hold its value, they move into assets. When they start to question whether assets are overpriced, liquidity dries up. When liquidity dries up, forced selling begins. And once forced selling begins in a highly leveraged system, entire market structures can unravel in days. Some of the earliest indicators of this erosion are already visible. Crypto is struggling to sustain momentum despite massive inflow cycles. Gold has retreated after reaching record highs. Housing activity has begun to stall under the weight of mortgage rates that are pricing out the average buyer. Commercial real estate delinquencies have now exceeded the levels that preceded the 2008 crisis. The stock market continues to push upward, but the divergence between prices and fundamentals has never been wider. This is not the behavior of a healthy financial system. It is the behavior of a system stretched by liquidity. When interest rates are low and credit is cheap, money moves fast. It flows into assets, into speculation, into anything that looks like it might rise. Cheap money feels like prosperity because it inflates the value of everything it touches. But when interest rates rise, the pressure reverses. Every dollar becomes more expensive. Every debt becomes heavier. Every asset becomes more sensitive. And those who borrowed against inflated assets find themselves exposed. For more than a decade, investments were judged not by their profitability, but by their rate of appreciation. Investors stopped asking whether something made sense. They asked only whether someone else would pay more for it later. That mentality is the definition of bubble psychology. It is what drives market behavior from rational evaluation into collective speculation. It is the same psychology that drove the roaring 1920s, the dot-com frenzy of the late 1990s, and the housing mania of the early 2000s. But this time, the phenomenon has spread to every market at once because the underlying cause, excess liquidity, was global and systemic. The most dangerous part of the current financial structure is not the scale of the bubbles themselves, but the lack of buffers to absorb impact when they deflate. In 2008, the problem was largely concentrated in housing and banking. Painful? Yes, but containable. The government could bail out banks, stabilize credit markets, and cut interest rates to stimulate recovery. That playbook no longer exists. Interest rates cannot simply be cut towards zero again, not without unleashing inflation that would erode the currency and destabilize faith in the dollar itself. And printing money on the scale required to support asset markets today would not merely inflate prices, it would risk destroying the credibility of the financial system entirely. The very tool that rescued the system in the last crisis is the same tool that has now placed it in jeopardy. This is why policymakers and central banks now face a trap with no painless exit. If they raise rates, the debt burden accelerates and defaults spread. If they lower rates, liquidity floods back into markets and bubbles inflate until they burst under their own weight. If they maintain current rates, the compounding interest on the national debt continues to consume the budget from within. Every path leads to pressure. Every pressure leads to instability. And instability, when built on leverage, does not unwind slowly. It snaps. The timing of that snap cannot be known in advance. Markets can stay irrational longer than observers can stay skeptical. Asset prices can rise well beyond any valuation logic before gravity takes hold. But the math does not disappear because people stop looking at it. And the longer the imbalance persists, the more sudden and severe the correction must be when it arrives. The underlying forces shaping the system are not emotional. They are mechanical, they are mathematical, they are structural, and they are converging. The question is no longer whether something breaks, the question is who will be prepared when it does. Confidence is the oxygen of financial systems. Markets function because people believe they will function. Currencies retain value because people agree they retain value. Debt is honored because people trust it will be repaid. The modern global economy rests almost entirely on this invisible foundation of shared belief. And when that belief weakens, systems that once appeared unbreakable can fracture with stunning speed. The point at which belief breaks is rarely obvious in advance. Sometimes it arrives through a dramatic event, a failed debt auction, a major institution collapsing, a geopolitical shock. Sometimes it arrives through a slower decay, a shift in tone, a quiet withdrawal of trust among those closest to the mechanisms of credit. The exact catalyst is unpredictable, but the conditions that make the break inevitable are unmistakable. Right now, the government is borrowing roughly $50 billion every week. Not once, not occasionally, every week. In the last 18 months, the Treasury has issued more than $2.5 trillion in new debt. That surge wasn't financed by the usual global buyers, nations, pensions, sovereign funds, but by a temporary pool of private cash sitting in money market funds. That pool is now nearly exhausted, yet the borrowing continues, and will continue. This means new debt must find new buyers, and to attract them, yields must rise. But when yields rise, the cost of servicing all existing debt rises along with them. This is the trap. The system requires higher yields to function, but higher yields accelerate the system's breakdown. Eventually, we reach a point where the debt cannot be sold without offering returns that make the government's fiscal position untenable. Investors hesitate. Auctions weaken. Confidence slips. If buyers refuse to finance the debt at sustainable yields, there are only two ways the government can respond. Print more money to buy its own debt, weakening the currency. Default, crystallizing a loss of trust instantly. Both outcomes break confidence, one slowly, one violently. This is why the next phase of this crisis will revolve around credibility. When does the world decide that the United States debt machine has crossed from stable but large into unpayable in any real terms? Subfament, when does the global market conclude that the dollar is being diluted faster than stability can be maintained? Confidence does not erode evenly. It fractures in one sudden instant when the narrative shifts from "this is fine" to "this is no longer sustainable." If a treasury auction fails, meaning there are not enough buyers at current yields, the signal is unmistakable. The world no longer believes that debt will be repaid without destroying the currency. That realization would freeze global markets in hours. Banks would restrict lending. Liquidity would vanish. Risk assets would plunge. The cascade would be fast and brutal because of leverage. Credit markets are interconnected. If one key node seizes, the entire structure tightens. During stress, the scramble for liquidity becomes primal. Margin calls accelerate selling. Selling triggers more margin calls. And what looks like a gradual repricing suddenly becomes a cliff. This is how confidence collapses, not through steady decline, but through a chain reaction. Some imagine that the government will simply print unlimited money to avoid default. But printing is not free. Printing transfers the cost of avoiding bankruptcy directly into the currency itself. If debt holders realize they are being repaid in devalued dollars, their incentive is to exit before others do. And when everyone tries to exit at once, the value of the currency falls rapidly. If the currency loses credibility, the financial system loses its anchor. The United States has avoided this fate for generations because the dollar has been the world's reserve currency, backed not merely by economic strength, but by global trust in American stability. That stability is now being tested by mathematics. Interest on the national debt has become one of the largest expenditures in the entire federal budget, not because of war, not because of new government programs, but because of the compounding weight of old decisions. When a nation spends more on interest than on investing in its people, its infrastructure, or its future productivity, the future begins to shrink. The political consequences of this dynamic are already visible. When the fiscal pie shrinks, politics shift from cooperation to tribal competition. People stop asking how to solve shared problems and start asking how to protect their piece of a shrinking reality. Every election becomes existential. Every opponent becomes an enemy. The center collapses. Extremes harden. History is clear. When nations exceed roughly 130% debt to GDP, the social fabric begins to fray. Class conflict intensifies. Institutional trust breaks down. Political tensions escalate into open hostility. And eventually, something snaps. The United States is on track to cross that threshold within a decade. The pressures building today are not only economic, they are social, cultural, psychological. A society drowning in debt does not debate policy. It fights over survival. It turns inward. It fragments. And in that fragmentation, the system loses the one thing it cannot function without: shared belief. This is why timing is so difficult. Social tipping points do not announce themselves. They emerge suddenly when enough people silently reach the same conclusion. This can no longer continue. The shift happens internally long before it appears externally. By the time the visible break occurs, the real break has already happened in the collective mind. The financial break will arrive the same way. The precise catalyst, whether a failed auction, a credit freeze, an inflation spike, a geopolitical shock, matters less than the conditions surrounding it. The system is highly leveraged, deeply interconnected, and dependent on confidence that is already thinning. In environments like this, wealth does not disappear. It transfers. The transfer occurs from those who hold liabilities to those who hold liquidity, from those who are leveraged to those who are prepared, from those who assumed stability to those who anticipated fragility. Collapse is not a single event, it is a process, and that process is already underway, quietly tightening around the edges of the economic machine. But in every collapse, there are individuals who emerge on the other side stronger, because they position themselves before the break instead of during it. Those who survive are those who recognize that the system is no longer operating on growth, but on borrowed time. Every major reset in economic history has followed the same underlying pattern. Leverage expands, confidence stretches, and a moment arrives when the old system can no longer support the promises it has made. When that moment comes, wealth moves. Not by chance, not by luck, but by position. Those who prepared are not merely spectators to collapse. They become the new foundation on which the next cycle is built. The myth is that collapse is chaos. The reality is that collapse is reorganization. It is the transfer of ownership, the unwinding of excess, the clearing of what no longer functions. It is painful, but it is also clarifying. And for those who are positioned well, it is transformative. The people who survive such transitions are not necessarily the most intelligent, nor the most connected, nor even the wealthiest. They are the ones who understand timing in terms of structure rather than dates. They do not try to predict the day, the month, or the year. They prepare for the inevitability of imbalance correcting itself. They recognize that the end of a cycle does not unfold through headlines. It unfolds through liquidity. Liquidity is the lifeblood of survival. Those who enter a downturn leveraged are forced to sell to survive. Those who enter with liquidity are able to buy when prices disconnect from underlying value. This difference determines who suffers and who ascends. During calm periods, leverage looks like intelligence. It amplifies returns. It makes ordinary investors look brilliant. It rewards aggressiveness and punishes caution. But in a correction, leverage is a vice that tightens until it crushes. And in a system flooded with leverage, even a small change in conditions can trigger a cascade. This is why timing collapse by date is impossible. But identifying its inevitability is not. The more leveraged the system becomes, the more violent and sudden its unwinding must be. The pressure has to go somewhere. And in an environment where everything is inflated, everything is exposed, this is not a moment for gambling. This is a moment for positioning. The individuals who navigate through transitions like the one forming now do not rely on certainty. They rely on structure. They build portfolios that do not require perfect timing. They avoid the psychological trap of all in and all out. They avoid the emotional impulse to chase every wave or respond to every headline. They position themselves to remain solvent longer than the market remains irrational. For most, the first step is brutal in its simplicity. Reduce vulnerability. Vulnerability lives in debt, especially variable debt. In a rising rate environment, debt is oxygen turning into smoke. The payments become heavier, the cash flow becomes thinner, and eventually the trade-offs compound into forced decisions. Removing that vulnerability early can determine whether a person becomes a forced seller or an opportunistic buyer. The second step is just as crucial. Build liquidity slowly, consistently, without the emotional drama of prediction. Liquidity is not merely cash. It is optionality. It is the ability to choose rather than react. It is the ability to wait rather than chase. It is the ability to buy when others are panicking and to hold when others are desperate. The third step is clarity of focus. Not all assets survive a deleveraging. Many speculative investments built on hype and narrative rather than fundamentals will simply vanish. Businesses with no real margin, no pricing power, or no sustainable demand will collapse. But businesses with strong balance sheets, essential products, efficient operations, and disciplined management will not only endure, they will gain market share. True value is revealed only when liquidity drains away. During booms, Everything looks like a good investment because liquidity hides weakness. During corrections, liquidity exposes reality. This is why study matters. This is why understanding fundamentals matters. This is why patience matters. Opportunity is not created by the crash. It is revealed by it. But there is a deeper preparation required than financial positioning. There is mental preparation. The ability to act when others are paralyzed is not instinctive. It must be cultivated. Most people freeze when confronted with volatility. They wait for clarity that never arrives. They seek reassurance from the crowd at the exact moment when the crowd is least reliable. They trust consensus at the exact moment consensus becomes blindness. Preparation is the antidote to panic. The ability to execute during upheaval comes from understanding what is happening structurally, not emotionally. If you know the system is over-leveraged, if you understand that collapse is not failure, but recalibration, if you recognize that the future belongs to those who can endure the correction rather than avoid it, then volatility stops feeling like danger and begins to look like opportunity. The wealth transfer during a reset is massive, but it does not reward fearlessness. It rewards discipline. It rewards those who resist the urge to chase euphoric highs. It rewards those who understand that stability built on debt is not stability. It rewards those who do not mistake liquidity for wealth. It rewards those who recognize that every bubble, no matter how large, no matter how deeply rooted in belief, resolves itself in the same way, through revaluation. The next era will not belong to those who maximize leverage during the boom. It will belong to those who protected purchasing power, maintained liquidity, diversified prudently, and waited for the moment when distressed assets return to prices grounded in reality. When the correction arrives, it will not announce itself. It will not be gradual. It will not be polite. It will feel sudden, even though the underlying pressures were visible long before. And when that moment arrives, the question will not be, who predicted it? The question will be, who prepared? Those who are positioned will not merely avoid loss, they will shape the landscape of what comes next. Because every collapse is the end of one order, but it is also the beginning of another. And the people who are solvent at the turn of the cycle do not just survive the new era, they define it. When the flood comes, most people will be caught in the open. Not because they didn't see it coming, but because they convinced themselves they had more time. The system teaches people to react instead of prepare, to wait for confirmation instead of respond to conditions already in motion. But the moment of confirmation is always too late. By the time the headlines arrive, the transfer is already underway. This is why the ones who hold liquidity while others chase returns are dismissed as overly cautious, right up until the cycle turns. Then they are the ones who step into the market and acquire assets others are forced to abandon. Not through aggression, not through luck, but through discipline. It is discipline, not optimism, not fear, not prediction, that determines who stands on the far side of a reset in strength rather than regret. Because every era of prosperity that follows crisis is built by those who were ready in the crisis itself. The next chapter of wealth creation will not belong to those who believed the good times would last forever. It will belong to those who understood that cycles end, that debt must be reconciled, and that liquidity is not just capital, it is opportunity. If you are watching this, the point is not to be afraid. The point is to stop pretending that what is happening is normal. The system is not operating on growth anymore. It is operating on deferral. And deferrals always resolve. You do not need to time the moment of resolution. You need to not be in the blast radius when it occurs. Hold less debt than the people around you. Hold more liquidity than the market thinks is reasonable. Own assets with real utility, real cash flow, real durability. Understand that wealth is not measured by how much you appear to have during the boom, but by how much you still have after the correction. Because corrections are not endings, they are beginnings. They clear out what was unsustainable. They reset prices to reality. They create the opportunity for a new cycle to form. And the people positioned correctly at the turn become the architects of the next era. If this message resonated with you, if you want to stay informed, prepared, strategic, and calm while the rest of the world reacts emotionally, make sure you subscribe. There is more to cover, much more. And when the system shifts, those who understand what is happening will not only endure it, they will shape what comes after. Subscribe, stay sharp, and prepare with intention.